I think the fears here are going to shift from rising interest rates and higher inflation, potentially to recession, especially, and you've heard me on this before, because we see inventories piling up throughout the ecosystem. So innovation stocks in the public equity markets are down, I'm going to say broadly, 50 to 75% in the last year. I mean, that's as bad as it got during 08, 09.
Venture capitalists may be predicting trouble ahead for the private markets, but Cathie Wood has always danced to the beat of her own drum. The chief executive of ARK Invest, the asset manager known for its bold and risky bets on tech and innovation, recently said that ARK is planning to launch a fund that will invest across both public and private markets. Right now, ARK's funds invest solely in public equities. Hello and welcome to Money Talks. In today's video, ARK Invest CEO Cathie Wood updates about ARK Invest's recent strategy to invest in innovation-based ideas like Bitcoin, Zoom, and Tesla. Cathie also analyzes the current markets, high inflation, and the rising volatility. Make sure to stick around till the end of this video where Cathie Wood explains the chances of a global recession in 2022. So, without wasting any time, let's dive right into the video.
And I do want to talk a little bit about volatility here. Volatility has become the watchword. And as Brett said in his opening remarks, many people associate volatility with risk. Volatility is more associated with uncertainty. And when time horizons collapse, as they have within the last year, then the volatility does increase. We use volatility to our advantage. We concentrate towards our highest conviction names, and that tends to work out very well as we go through these corrections.
While ARK may be known for its ETFs, whose performance soared to remarkable heights during the pandemic, Wood isn't new to the world of private investing. She is personally a limited partner in UP Partners, a $230 million early-stage venture capital fund focused on mobility, whose partners are co-hosting the summit in Bentonville.
And that I hope our research today telegraphed to you. It's also very important to keep that 5-year investment time horizon. The difference between linear growth and exponential growth when you're talking about a 5-year period is enormous. And because Wright's Law gets us to, I think, to the right answer in terms of the exponential growth trajectories, the surprises are going to be enormous. And most important, we like to say, as we're focusing on the 5 years, keep your eye on the prize. We realize it's been a very difficult market. We also do believe, and our conviction this past year actually has increased, that these exponential growth trajectories have been accelerated by COVID, and even more so now by the turmoil we're seeing in the labor markets, logistics, and in the financial market. And then reflecting on Raoul Pal about blockchain, just innovation is evolving so quickly. We have to just listen and look at the tone changes that take place from one conversation to the next to understand how rapidly the world is going to change. But Raoul said something I thought very important, and it does address an elephant in the room. We know that innovation in the equity markets, the public equity markets, not the private equity markets, has been ravaged in the last year. It's about a year that it has been ravaged. And Raoul mentioned that when there is a change in expectations, and last year, as we were getting our vaccinations, the thought that the economy would open up and interest rates would go up, inflation would go up, but would be tamed. During the year, there was a change. The supply chain issues did not go away. And so this fear about what inflation and interest rates are going to do has gripped the market. First, it gripped the innovation space, almost exclusively in a puzzling way. Now it seems to be affecting the market a little more broadly. But I will say now that the 2-year Treasury and the market itself has priced in at least 4 interest rate hikes, that this possibility is priced in the equity markets too, increasingly. And if anything, oil prices going up are an incredibly burdensome tax on the lowest socioeconomic demographic sectors in our economies.
But while it may not be an entirely new rodeo for Wood, it's still a rather challenging time to debut a crossover fund. Hedge funds like D1 Capital Partners or Tiger Global that straddle both public and private investments have reported billions in losses this year as public tech stocks plunge, and Wood's publicly traded funds have tumbled, with its flagship ARK Innovation ETF trading more than 50% lower than it was in January. With the path to an IPO largely closed for the moment, and some of the industry's tech darlings started to cut their valuations, asset managers like Fidelity are proactively trimming the value of their own positions, and players like T. Rowe Price are rolling back their pace of deals. Some growth equity investors are turning focus to earlier stage investments or companies most poised for profitability.
Now, in the private markets, of course, we're seeing one example after another where the pricing is up in the last year. We're seeing up 50 to 100%. And I think the private markets do have it more. They're more correct in terms of what they should be discounting right now, because of what you heard today about research, how profound the changes are, how exponential the growth will be, and how the equity market cap is going to explode in these areas. And we really do believe that will be the case. Now, besides interest rates and inflation, there's been a double whammy in the public equity markets, and I think this is what helps explain what's going on. The move to risk off for many traditional asset managers means get back to your benchmarks. And if you look at the broad-based benchmarks, even the broad-based tech benchmarks or tech-oriented benchmarks, you're going to see that they are short innovation, true innovation. They're mostly in that the innovation that they're capturing is mostly in the mega cap tech stocks. They've become a disproportionate weight in many indices, and I would submit in many assets, portfolios in the traditional asset management world. This move to benchmark style investing, we believe, has been turbocharged during the last 20 years by the tech and telecom bust first, and then the 08-09 meltdown. And the risk aversion in the markets is palpable. And so going back to benchmarks or repositioning portfolios so that they are closer to their benchmarks seems to be what has been going on. What happens then? Well, they're selling the real innovation stocks out there, the emerging innovation stocks, and those that are going to create the outcomes that we showed you in our research today. Traditional research is becoming very benchmark sensitive as well. It's not just the portfolio managers, it's their analysts. And they have also become very short term in their time horizons. There are two other characterizations of traditional research out there that ARK has actually tried to capitalize on in terms of inefficiencies in the marketplace. The coverage in the traditional asset management world of analysts is broken down primarily by sector or industry or sub-industry, very specialized, very narrow, and as I mentioned before, typically very short term. And because of the siloization their ability to understand the convergences that are taking place between and among the 14 technologies that we touched on today, they're not able to see them as clearly as we are. We are looking for them.
So, do you think Cathie Wood's innovation-based strategy will work for ARK Invest in the long term? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.